Right, we have 14 minutes to go through my 8 favorite on-chain indicators and why they must not become a crutch. So, full disclosure, I was one of those people in 2021 thinking that Bitcoin would hit 90 to 100K Bitcoin. And guess what? I was wrong. We hit $69,000 before the retrace. Now, I think the reason why I thought that was because there were so many on-chain analytics suggesting 100K. That's what, when earlier I was saying that it doesn't always hit the top of the line. With all of the on-chain analytics at that point, everything was screaming 100K, so that was why. And I guess I relied too heavily, or I put too much weight on-chain analytics. So I've got egg on my face. Now, AI is still not that good, because I uploaded my cheesy mug and I said, this is me, can you please recreate a pic with egg on my face? And it changed what I look like. And I asked a few more times, like, that's not me. So, hey ho. So, yeah, basically, as I said, there are 9, that's me in cartoon form. There were 9 on-chain metrics that all indicated 100K Bitcoin by the end of that cycle. So I used it as a crutch and based all of my sort of, yeah, I guess theorizing and projections based on that. So obviously I have hindsight now, I've got battle scars. So the real trick with on-chain analytics is knowing which one to use and when to use, because not all on-chain is the same. So stock to flow is good for a lot of assets, like gold has been for hundreds or thousands of years, and it's somewhat accurate for Bitcoin. Now, from now on, I will glance at stock to flow every, probably once a quarter, just to see, more out of morbid curiosity, how accurate it has been, or it will be. But I am curious to see if stock to flow turns out correct or the power law turns out correct. Because we now have 2 competing models, which Giovanni says stock to flow is now useless, and it is in that. You'll see on Wednesday. Yeah. Because the end of this cycle, supposedly, with stock to flow, we're looking at 500K Bitcoin. I think that's a bit hard to believe. So this is more out of curiosity, but stock to flow. Realized price is a good one. I always use realized price as like, what is the lowest Bitcoin should fall to and rest and sort of consolidate around. So realized price is basically, it's taking the value of the Bitcoin, the last time it moved, or was transacted, divided by the current circulating supply. And so what this means is it's effectively showing the average cost basis of Bitcoin from when it was bought. And when you look at Bitcoin over time, it has been a really good support level. So it's on very few occasions has it busted realized price. And every time it has, it's really been the ultimate lows. So one of the reasons I like it is that if it ever busts through realized price, then that's pretty much the low of that cycle. And in the last 3 cycles, or 4 cycles, boom, busted below. It didn't hang around there for long. Here, and then more recently around the 15K level. So it's good for detecting lows, in my opinion. But it also means that, like, even in a bull market, it tends to sort of have this sort of a gap away from it, if that makes sense. And there are other indicators out there that basically measure the deviance or the deviation from realized price and wherever the price is. So if you had an oscillator along the bottom, you could have an oscillator, so when it reaches like that sort of distance from realized price to the peak, it will be very high on the sell territory. So you can have a green zone and a red zone. So when it goes below realized price, it will be in the green zone. If it had whatever that sort of deviation, that would be get the hell out. Oops. What's this? This looks fancy. Wise wolf, whatever that is, etc. So there are ways that you can interpret it. So I like realized price personally. The Hodl ratio is a similar thing. So Hodl band. So basically, what it's taking into account are the differences between the 1 and 2 week wallets against the 1 year wallets. So basically old and new supply, and it's taking the realized cap of that. So it's called the realized Hodl ratio. So the Hodl ratio, which is the one on-chain metric that is I have always used, and it's worked pretty well, because I've always said when it enters the green band and starts moving up, that is when that's when it signaled the bottom. So it's still a lagging indicator because it's showing us, that was the bottom. Because in a falling market, you don't know, it's always pulling back. You don't know, was that the low or was that the low? But when it enters the green and starts exiting out of the green, it shows you the low. Because every single time it's done that, it's absolutely nailed the bottom. So I was looking at this a lot in 2022, if you go back to the old trading pubs. The other one I like is Pure multiple. So this analyzes the stress that miners have in terms of their revenue. So obviously when Bitcoin is booming, they're making absolute bank. When Bitcoin's falling, they're not. Miners have to then play that seesaw of like, they're sending a larger chunk of the Bitcoin that they're mining to just cover operating costs. Whereas when Bitcoin's booming, they only have to sell a little bit to cover their operating costs. And so basically some of the lows can be seen with the Pure multiple, because when we're in this band, when price is down and we're down here, it's showing that the miners are under huge stress in terms of their profit and revenue. Or revenue, I guess, is the same, but profit is not. So that's a Pure multiple. They're good bottom indicators. So at the moment, I've really only shown you good bottom indicators. So they're the ones that are good for that. Here's a good top indicator, the Mayer multiple. This is really simple. What a lot of humans, a lot of people like to do is draw a 200 EMA, or moving average on Bitcoin. And they treat that as, when it's above 200, we're bull market. When it's below, bear market. So what the Mayer multiple does is it draws the 200, so the blue one, moving average, and all it's taking is the deviations of price from the blue line. So here, if we take this peak, the blue line, that's a massive deviation from the 200 EMA. So therefore, here on the oscillator, the red and the where is the green? Yeah, it's up here. It's massive sell signal. And the opposite. So when the price is really low compared to the 200 EMA, it's saying that massive deviation from it. So much like I said with the realized price way to look at it, the Mayer multiple is similar-ish. And the 200 EMA is a bit closer to price than it is on the realized cap. So that's a good topping indicator in my opinion, to a degree. Also, in terms of growth, you can look at active address growth, and that tends to show you, it's quite a fuzzy indicator, because normally when you see massive spikes in active address growth, what's this? This is retail market going, I need to buy Bitcoin, Coinbase, and then they start, and so you see a massive spike in retail. But it's hard because when your face is, when you're in the thick of it, like, is this a massive retail increase in retail, or is this the retail spike that we're waiting for? And then, you could sell everything here and then realize, oh shit, I was early, and then Bitcoin buggers off without you. So really, if you're going to use the active address growth as a topping indicator, you really need to look for massive spikes. So it's a bit fuzzy, this one. I've always liked this one. I call it the dumb money versus smart money. So historically, whenever the smart money and the dumb money converge, that's basically the smart money selling to the retail market. So basically, the smart money over here is deemed the old supply. Dumb money, or new money, is the retail. So when you have a divergence, that's basically the beginnings of a bull market. And what happens is it diverges quite fast, and then it sort of peters out a bit. And you see the bull market start. And when the retail market starts plowing in, guess what? The smart money are like, yeah, you can have my Bitcoin. And so when they start to converge, it normally coincides with massive, with sell-offs. So here's the sell-off, boom. And then very quickly, the retail money runs away because, Bitcoin's a scam, I've lost all my money. And then they run away. Whereas the smart money are like, I will buy this. Just like if Sainsbury's had a 70% price cut on all of its food, what do you think people would do? They'll have multiple shopping trolleys, just, it's like petrol pumps when, petrol's cheap or expensive. So at the moment, guess what? We're having a divergence of smart and dumb money. So this is bull season territory. And then for the top cap and average cap model. So this is an interesting one. This was created by Willy Woo, who created the top cap model. And what he was basically doing is he was taking the average cap, so a bit like the realized price I was saying, and then he was just giving it a multiple. And so this is one of the crutches I leaned on, because historically, before 2021, the top cap model was bang on. It got every high, boom, 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 boom. And so there was me going, pretty good model. 100K is the next model, 100K is the next, so this is, when you look at this in terms of price, the red line at 2021 was 100K. It was like bang on a 100K level. So that was one of the things I was looking at. And it also caught the lows as well, pretty well. However, guess what? It didn't quite. So I think they've adjusted this, or what I'm looking at is something different now. I look at the 15, that's it, yeah. So personally, moving forwards, I'm going to be looking at the 15 multiple. So before, the red one, he took the average cap and times it by 35, and he was effectively just curve fitting the highs. So that's typically what happens when you curve fit a model. The future is not as predictive. It's not like the power law where it's a set. You're not fudging anything with the power law. Whereas with stuff like this, it's all fudging. So I think a better one to look at is the times 15 top cap. So this way, if it goes beyond your orange line, not bad, you're happy. But when you get near the orange line, I think I'm going to get a little bit nervous. Maybe just before the orange line for the next one, I'm going to get a little bit nervous. So personally, what I did was I extended I basically got a little ruler out and found out where the end of 2025 is, because my December 2025 level, and I got my big fat drawing pen out and tried to emulate what it may look like. So it's pretty flat, but you see as the bull market goes up, it slopes up a tiny bit on each one. I've done a slight slope up, and I've just tried to see what the market cap of Bitcoin will be on the orange price. Me just being really conservative. So 6 trillion. That's interesting. 6 trillion divided by 20.397 million circulating supply on the 1st of December 2025 gives us a Bitcoin price of 294K. That's a bit high. That's a lot higher. That's more than double what I think and what Power Law thinks. So is it going to be another case where actually, just like it didn't reach the red line here in 2021, is it going to come short of the orange line in 2025? Possibly. That's all I can say. And this is my Bitcoin market cap model for ages now. So this is Bitcoin as a market cap. And personally, even though I've discovered the power law and everything else out there, I still don't think Bitcoin's market cap is going to deviate from this hole. That green hole, it's a bit of a cop-out, isn't it? Because I'm basically saying Bitcoin's going to be between $2 to $5 trillion. Which means it's either 98K to 245K. It's a massive thing. But when you're looking at this on a log chart, log linear chart, it's pretty sensible, don't you think? It's a sensible-ish projection based on just a normal log chart. So yeah, I still think it's going to be in that. I will celebrate if it ends up being in that hole. So yeah, I'll be like, I told you so. Here's my big range, and I told you so. So there we go, Lewis. 15 minutes in your face. In summary, well, actually, I haven't quite finished. Don't rely on on-chain. Treat them like any other indicator. Just use it as more of a, that's interesting. They don't account for gross market manipulation. So we have now evidence that there was gross market manipulation by FTX in 2021. And I still think that's the main reason we didn't see 100K. There was a lot of manipulation back then. And signals are, yeah, are a rough price and time area. So yeah, that's also me, apparently.